At 9:14 a.m., a headline flashes across trading screens. New tensions reported between Israel and Iran. Within minutes, oil prices climb. Gold rises. Stock markets hesitate. The US dollar strengthens against several currencies. No oil field has stopped pumping. No factory has shut down. No shipping lane has closed. Yet billions of dollars have already changed hands. It's one of the strangest features of the global economy. A political headline from one region can influence retirement funds in Canada, airline profits in Europe, food prices in Asia, and inflation expectations in the United States all before lunchtime. Why? Because markets aren't just reacting to what happened. They're trying to price what could happen next. And when the words Israel and Iran appear in the same headline, investors aren't reading just another news story. They're calculating risk. For decades, the Middle East has occupied a unique place in the global economy. Not because every country there is economically dominant, and not because every conflict becomes a global crisis, but because the region sits at the intersection of something the modern world still depends on: energy. Although the global economy has diversified over time, the Middle East remains one of the world's most important oil and gas-producing regions. Much of that energy moves through critical shipping routes, and many of the world's largest producers are located nearby. That doesn't mean every regional event disrupts supply. Most don't. But financial markets are constantly asking one question. Could this one? Imagine you're the chief executive of a major airline. Fuel is one of your largest operating expenses. Your company has flights scheduled months into the future. Then a major Israel-Iran headline appears. You don't know whether tensions will ease tomorrow or worsen next week. Waiting could be expensive. So, you begin locking in future fuel prices. Now, imagine thousands of airlines, shipping companies, manufacturers, and investment funds making similar calculations at the same time. None of them knows exactly what will happen, but none of them wants to be the last to react. Suddenly, markets move not because reality has changed, but because expectations have. This is where the story becomes more interesting. Most people assume markets react to facts. Professional investors know they often react to probabilities. Suppose analysts believe there's only a 10% chance of a serious disruption to regional energy exports. That sounds small, but if the economic consequences would be enormous, markets may still adjust prices today. It's similar to buying insurance. You hope your house never catches fire. You still pay for protection. Financial markets do something remarkably similar. They constantly price the cost of uncertainty. Oil is usually the first place people look. For good reason. Higher oil prices don't stay inside the energy sector. They spread. Trucking becomes more expensive. Airlines face higher fuel bills. Manufacturers pay more to transport goods. Food prices can increase as transportation and fertilizer costs rise. Even products that seem unrelated to oil begin becoming more expensive. Inflation doesn't always begin in the grocery store. Sometimes it begins in the commodity market. But here's something many people overlook. Sometimes, oil barely moves at all. That surprises people. After all, if the Middle East is so important, shouldn't every escalation send prices soaring? Not necessarily. Markets also ask another question. Will actual supply change? If production continues normally, if shipping routes remain open, if alternative producers can help meet demand, or if investors believe the situation is unlikely to spread, oil prices may stabilize after an initial reaction. The headlines may sound dramatic. The market may decide the economic impact will be limited. That's why similar headlines can produce completely different financial reactions. Context matters more than emotion. Then there are safe haven assets. When uncertainty increases, investors often look for places they believe are relatively stable. Historically, assets such as gold and U.S. Treasury securities have often attracted demand during periods of heightened geopolitical uncertainty, although markets don't always behave the same way. The U.S. dollar can also strengthen during periods when investors seek liquidity and perceived stability. Notice what's happening. Money isn't disappearing. It's relocating. Fear changes where capital wants to live. Central banks are watching too. Imagine inflation has finally started cooling after months of higher prices. Then oil suddenly rises sharply because geopolitical tensions escalate. Energy becomes more expensive. Transportation costs increase. Inflationary pressure returns. Meanwhile, another group is watching these developments just as closely. Central bankers. Imagine inflation has finally started cooling after months of stubbornly high prices. Then energy markets suddenly become more volatile. Fuel becomes more expensive. Transportation costs begin creeping higher. Businesses face rising operating expenses once again. Now, policymakers have a difficult decision to make. Do they lower interest rates to support economic growth? Or do they keep borrowing costs higher for longer to prevent inflation from returning? A shift in energy prices can ripple through almost every part of the economy, making those decisions far more complicated than they first appear. But energy isn't the only concern. Global trade depends on a small number of critical shipping routes. Every day, enormous volumes of oil, natural gas, consumer goods, and industrial materials travel through a handful of maritime corridors connecting Asia, Europe, and the rest of the world. If shipping becomes slower, more expensive, or less predictable, companies everywhere begin feeling the pressure. Manufacturers wait longer for raw materials. Retailers pay more for transportation. Importers face higher insurance and logistics costs. Eventually, those additional expenses work their way into the prices consumers pay. The impact usually isn't immediate. It spreads gradually through supply chains, often taking weeks or even months before it becomes visible on store shelves. This is why financial markets often react long before the real economy does. Investors aren't simply responding to today's news. They're trying to estimate tomorrow's costs. Will energy stay expensive? Will transportation become more difficult? Will inflation remain under control? Will businesses delay investment until uncertainty fades? Every new piece of information changes those expectations. And when millions of investors adjust their forecasts at the same time, markets move almost instantly. History has shown that periods of heightened geopolitical uncertainty can influence commodity prices, investor confidence, and global trade. But history also shows something else. Not every crisis becomes an economic disaster. Sometimes, supply chains adapt. Alternative producers increase output. Shipping routes remain open. Markets calm down faster than many people expect. That's why experienced investors pay attention not only to the headlines, but to what actually changes underneath them. Perhaps the biggest economic impact isn't always the event itself. It's the decisions people make because they believe something might happen. A company delays building a new factory. An airline locks in future fuel prices. A shipping company changes its routes. Investors move money into safer assets. Banks become more cautious about lending. Individually, these decisions seem small. Together, they quietly influence the direction of the global economy. Uncertainty has a cost, even when the worst-case scenario never arrives. The next time you see a major geopolitical headline, don't just watch the news. Watch the oil market. Watch shipping costs. Watch bond yields. Watch currencies. Those movements often reveal what investors believe the future might look like. Because in today's interconnected world, markets don't wait for certainty. They constantly try to price tomorrow before tomorrow arrives. And perhaps that's the most fascinating part of modern finance. Sometimes, the biggest economic shock isn't caused by what has already happened. It's caused by what millions of people think could happen next.